Welcome to Yellow Tunnel. My name is Vlad Karpel. I'm CEO and founder of Tradespoon and Yellow Tunnel. And I'd like to go over today about earnings season and how to prepare for the next earnings season, and also how to structure your trade where you have favorable risk versus reward ratio. For those of you who are new, welcome. This is my brief bio. I was Executive Vice President and Head of Technology at Options Express from its inception through 2007. Options Express was an online broker-dealer acquired by Charles Schwab in 2011. At some point, the company was worth over $2 billion. I'm very proud of that experience. Since I left Options Express, I started Tradespoon in 2012. I've been trading my own money for over 15 years, mentoring and teaching Tradespoon subscribers and Yellow Tunnel subscribers how to trade stock and options. And I have a master's degree in computer science, specializing in technology and computer science. Since I'm going to go through some live trading examples, very important to look at the disclosures. Trading stock and options involve risk and not suitable for everyone. You must be aware of the risk and be willing to accept them in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own portfolio based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. All right, so let's talk about trading. Before we get into specific details of key support and resistance, I want to go over about the belief of when we entering the trade. Before I get into a trade, there is always a belief whether the market is going to go up or whether the market is going to go down, whether we're going to reach a current support level or current resistance level. What do you do when the trade goes against you, right? So let's take an example of current situation. Right now it's Monday. We had announcement from United States and China in terms of restart of the negotiations. And we've seen that the market rallied today as high as 297. So the market last week closed at around 292, 290. And a lot of people structured their trade with the assumption that the trade, that there will not be an agreement between the United States and China. So if you did that trade, and clearly now the trade went against you, what do? You know, do you close your trade because you clearly see that right now there is a positive momentum and potentially market can reach 300 or as high as 304 level. I currently believe that at this point market is overbought. We see 2 standard deviation move based on Bollinger Band. So 300 is overhead resistance. Potentially we can overshoot to 304, but I think this 300 level is an overhead resistance. So do you close your trade because the market can continue going higher from 295 to 300, or do you realize that the trade went against you because you assumed that there won't be an agreement between the United States and China and you are preparing for the market sell-off? So the correct, if the trade went against you and you were bearish on the market, the wrong assumption would be to alter information to fit your belief. Kind of waiting with the assumption that tariff negotiations will be prolonged and the market will sell off tomorrow or after tomorrow. So as humans, we usually trade based on 100%, whether we are correct or incorrect. And when the trade goes against you, we take these assumptions that we don't want to admit that we were wrong. And if you trade based on an assumption that you're always either 100% correct or 100% wrong, then it's very hard to trade when the trade goes against you. You need to realize that you trade based on the probabilities, and every time you trade based on a current level of support and resistance, sometimes you can be 75% correct, sometimes you can be 80% correct when you're using certain technology or statistics, but you can never be 100% correct. So the hindsight bias can negatively affect you as a trader. If you're going to blame yourself that the trade went against you because your belief is incorrect, or if you're going to alter your belief with the hope that the market is going to revert, then you will, more often than not, the trade will continue going against you. So following your trading plan, very important. Continue observing main support and resistance levels. And if the main support and resistance levels are broken, you have to be flexible and you have to be able to adjust your position. So being self-aware is very important. Closing your eyes and kind of asking yourself, why did I get into this trade? Why am I staying in this trade? Keeping your journal is extremely important to make sure that you do not let the losing trade take over your emotions. So now going into the future for the next 2 weeks, I'm personally trading based on the assumption that in the next week or two we will reach 300 level. But then as earnings season unfolds, there's a market is capped at 300. So this is the time where I want to close some of my long position, have limited exposure to the market, and potentially be market neutral, with the idea that the market can sell off and reach the 290 level. So buying this, as long as we stay in above 50-day moving average, buying at 290 I think makes sense, because you have 10 points to the upside and you have limited downside exposure. In the next couple of days, I'm going to wait for the confirmation. If we're going to make new higher highs and higher lows in the next couple of days, then I think the market will reach 300. If tomorrow or 2 days, in the next 2 days, we are going to make lower highs and lower lows, then I would expect that the market will sell off, and buying at 290 makes more sense. So short term, I'm bullish on the market. I think buying at 290 makes sense. Selling at 300 also makes sense. Long term, I'm a little bearish, and if the market does break 50-day moving average for a day or two, I would be the market neutral or take more bearish stand. All right, so again, one of the key takeaways for me is being self-aware, know why you're trading. Always be flexible in your beliefs. You trade based on a certain assumption and beliefs, and the trade goes against you. You have to adjust to your belief to the new information. It's okay to become bearish if the market breaks 50-day moving average, or if the market now it's all-time high, it's okay to be bullish even though you were bearish a few days ago. And some of the key takeaways are: look at the main support and resistance levels. 200 days simple moving average on SPY, 50-day moving SPY. As long as the market trades above 50-day moving average, I think we're still in the late stage of bull market. Structure your trade based on a favorable risk versus reward. Today I actually put on a hedge in DIA, being bearish at DIA, because we're at 52-week high and I don't see a lot of momentum behind that. So buying spiders put, buying DIA puts, buying VXX, buying treasury, buying gold, all of these could be used as a hedge mechanism to hedge your portfolio. Always have 30% of your portfolio in cash, and if you're trading stocks, consider buying cover calls, especially when you see market at all-time high. That's all I have for today. Thank you very much and have a great day.